We're also streaming to you live on yorbamedia.com. All right, Nick Santiago, my guest on this segment today, President and CEO in the Money Stocks. Nick, thanks for coming back.
Always great to be back with you, Michael.
Okay, well, what a day in the stock market today. What about the S&Ps?
Well, we got a huge move today in the market. I had been looking for more of a corrective move, and apparently the markets like what they heard, so they're moving up, and you got a nice little consolidation that was pretty choppy and sloppy, but it's moving up. You got a little bit of volume here, so I think the market has a chance to probably move up into the middle of next week when you come into the important FOMC meeting. Also, there's going to be that big German ruling on whether or not they're going to allow the ECB to buy bonds in the European Union. So there's still a lot going on, but right now the markets are talking, and they're moving higher, and we have to respect the tape. You can't fight it, and they're moving higher at the moment. So we'll see what next week brings, but I have a few ideas up my sleeve.
Talk to me.
Well, one thing I just want to point out that oil today, or gasoline I should say, not oil, but gasoline today hit a 3-year high. This is problematic. Gasoline is definitely a leading indicator. This is where people feel the pinch. Also, it affects consumer spending, which accounts for 70% of the United States gross domestic product. So that's a problem going forward. Now, I know we have elections going on, and the president wants to look good going into his big speech tonight, and you can't really say much when people say, hey, why is gasoline at a 4-year high? Because the dollar is selling off. That's really the answer. He'll blame it on speculators. But the truth of the matter is gasoline is at a 4-year high. Now, one thing I want to talk about real quick is oil rolled over today. Why is oil rolling over today? It's a pretty big sell-off. You take a look at the USO. It's selling off on 11 million shares right now. It's reverse course. It was up sharply this morning, and now it's negative on the session. It's pretty much the only thing negative out there today. So oil, if you take a look back, and you could just simply scroll back on the chart of the USO and go back to March, oil rolled over first before the stock market rolled over. So I still think we're in for a September-October correction, but probably it's not going to happen until another week or so. But with today's move, the correction will be small. It won't be as big as I originally thought it would be.
Okay, so that brings into the question here, are we looking at maybe a 1425 support now?
Well, I would still go with a little bit lower than that. I would go with probably a 136, 137 support area. So basically on the S&P cash, that would probably be around the 1360, 1370 level. That's still going to be very, very good support and a buying opportunity then if we do get down there.
Well, everybody's been waiting for us to break out of this range we've been in for a few weeks, and we finally did it today. My only reservation and question is this sustainable, and is there enough power in the Fed's actions, or whether it's ECB or the Fed, to be able to continue to push this much higher? Is it real, or is it not?
Well, cyclically, what I was expecting was one more correction, and then we go into pretty much what I want to call a short-term mega boom, and then the markets after that next phase would really run into trouble, because this you could make a case. Markets have bottomed in March of 2009. We're already 3.5 years into this. Rarely do markets go up much more than that. So you could go for maybe 5 years, and then you hit another bear leg. So we're probably, what I thought was going to happen, we'd get one more correction now into the fall season, and then the markets would go into that final upside and before a next bear leg. So, that's the longer picture. But right now, you have a solid day in the market from that consolidation that was being made, where the market was basically in a 25-point range for a couple of weeks, and today you're breaking out of it with a little bit of volume. The volume's not massive, so I still think that we could be due for a pretty good little pullback, but it's not going to be as steep as I originally expected.
Okay, all right. And your next cycle date is coming up here about the 12th. Is that what you're thinking about?
Well, I'm thinking the 12th. You want to know, this is pretty ironic, but you have the FOMC meeting coming up on the 12th and the 13th. That's a Wednesday and a Thursday. Normally, their meetings are scheduled for the Tuesdays and Wednesdays, the 11th and the 12th, but they moved it over to the 12th and the 13th. ironically, Germany is going to have that key vote on whether they're going to allow the Eurobonds to be traded by the ECB on the 12th. So I find it ironic that the Fed meeting is moved to the 13th, which is actually next Thursday. So I think after that, the Fed, they obviously cannot do a QE now. Germany will probably be disgruntled about it, and that would be our correction. But overall, I suppose you got to give the markets the benefit of the doubt now.
Okay, what about the U.S. dollar?
Well, the U.S. dollar, I wanted to bring that to your attention today simply because we had a beautiful inverse head and shoulder pattern that triggered on the spot price, and it failed last week. So that tells me, too, that the dollar is not going to be able to get up to that 90 level. I think the dollar still could bounce, but I don't think it really gets much above 84 now.
Okay. Now, I notice that the Treasury bond market is moving lower at a rapid pace. So I'm getting that it's just not profitable to be in bonds anymore, and it's risk on, and it's all coming out. There's a big rush to get out of the bonds and go someplace.
Well, the bond market had a pretty nice little move the last couple of weeks, but the truth of the matter is that it's going to be choppy in a big range. So the traders looking at TLT probably right now can watch the 120 level to the 130 level, and I think that's where bonds are going to chop around in here for a while. But ultimately, I do think that the bond market probably puts in a final high, whether it's a new high or just a pivot high at some point in the fall, and then I would not be looking to hold bonds on the long term anymore.
Okay. Now you want to talk about UGA, right?
I did want to talk about UGA, and I did elaborate a little bit about it, but it's just gasoline. And you could see here, really since the market bottomed, gasoline has just been on a tear to the upside. On June 21st, the UGA was trading around $45. Now it's all the way up around $60, and even today it went, close to 60. I guess it went above 61. So this is unsustainable. Gasoline moving at these highs here is just not beneficial for the economy. So I do think that we're still waiting for a correction here, but it's not going to be the major stock market correction that I was looking for. And high gasoline will be one of the catalysts for that.
Okay, then let me throw this one out. It's not really on our agenda today, but you made me think about this. This XLU, the utility sector.
Sure.
I see a turn here. Do you see higher utility prices as we go forward because of the possibility of greater rates of inflation?
Well, right now, utilities remind me a lot of the bond market. They're very, very similar because utilities will usually do well in a low interest rate environment. If interest rates start to creep higher, utilities should come down. Today, the XLU is having a pretty solid day, and I suppose it's going to stay in a range between this 36 area and up to around the 38 level. But I think ultimately, if the bond market is topped out, that the utility sector is topped out too.
Okay. All right. I wanted to figure out that. But as a general rule across the board, whether it's gasoline, it's crude oil, it's electricity, it's natural gas, do you see that sector moving in a bullish fashion? Well,
right now I do. And I do think as long as the central banks are continually inflating, gasoline and oil, after corrective moves can always be bought for trades. But as long as you have all this central bank inflation creation going on, they're not going to go down. They just can't go down that much because there's just too much money in that's going to go into it.
Okay, I got it. And, going back to your previous point, the tell here is a rollover in the crude oil market prior to a rollover in the equity market.
That's correct. And even if like I said, if you just go back and you look back in March, crude oil topped out there. It really started to fall in April and May, obviously, but it put in a high in the month of March, and that was a good indication for me that the stock market would correct. And if you go back even further to last year, which was 2011, you could see crude topped right in the middle of April, and then put a double top on May 2nd, and then it rolled over as well. Crude's a very, very good leading indicator going forward, no matter what. But like I said, with the dollar broken the way it is, and I believe it is now broken, they did break the dollar, the pullback here is not going to be as robust as originally expected.
Got it. All right, before you go, give everybody a way to reach you and get into that trading room.
Sure. Come on over to In the Money Stocks. Take a 7-day free trial to our research center. Also, check out our intraday chat room where you get to see our desktops live, and you'll see everything that we're doing in the market.
And thanks for posting all those videos and the comments on our social network page. I really appreciate it.
Always welcome, Michael. Thank you.
My pleasure. Everybody, Nick Santiago, President and CEO, InTheMoneyStocks.com. Go ahead and check out that trading room. That you'll see a guy be able to pull some really good trades off.